Good morning, everyone. Today we have Ind AS 33 that deals with आवाज थोड़ा इको हो रहा है. Yeah, so today we have Ind AS 33 that deals with earnings per share, and tomorrow we'll be covering the session on Ind AS 108. So these are the two things that we have over the weekend, as well as the Ind AS 12 that we have pertaining to taxes, which is pending. Okay. So we start off with Ind AS 33, earnings per share. Quite an important standard from practical perspective because this is the only standard that marries the market's pricing with the financial reporting. So it is one of those standards where you have a marriage between financial management as well as financial reporting. So why is earnings per share so crucial? Why is earnings per share so important? Just a minute. All right. Why is it so important? Why is it so crucial? You would be aware of a ratio known as PE ratio. What is PE ratio? Price earnings ratio. So market price per share divided by earnings per share. So we are having, if I just do a transposition, market price per share is nothing but EPS into P ratio. So that gives me the market price. I can come to know, I can make estimates of the market price using this. And this plays a key role, the earnings per share. That is why this standard is particularly important. Okay. All right. Now, there was a standard under the ICAP regime also that dealt with Ind AS, that dealt with earnings per share, which is your, I think, accounting standard 20. So the principles are largely the same, only where you have certain applications of financial instruments or certain different treatments under the Ind AS, you have a difference. Additionally, we have a couple of new points like contingent considerations. How do I treat that for the purposes of EPS? So those are the points that we need to look into. Okay, so with that background, let us start. What I propose to do today is we will be discussing the computation principles. Then maybe towards the later part of today's session or tomorrow's first part, we will look at what are the changes that we are seeing in terms of Ind AS. What are the changes we are seeing in terms of Ind AS? Okay. Yeah. Okay. So coming to our presentation, what we discuss is what is the concept of EPS already explained, computation, simple formula, treatment of certain items in the numerator, denominator, weighted average number, questions on basic EPS, what is the date for issue of shares we'll be covering today, what is my weighted average number in case of some अशोक आवाज ठीक है. एक मिनट में वही देख रहा हूँ.
गुड मॉर्निंग सर।
यस।
आदित्य क्या हुआ?
नहीं, वो एक जगह पे इको आ रहा है। आई एम नॉट एबल टू
अभी आप
आइडेंटिफाई।
बोलो, मैं आप
यस।
बोलिए, मैं चेक करती हूँ।
One second. All right. Let me continue. Okay. So then weighted average number in case of bonus, in case of rights issue, as well as buyback of shares and measurement of diluted EPS, options and warrants. So up till this is what we intend to continue. Just a minute. I'll just log out and log in again. Just give me a minute.
सर आपके टैब का जो माइक है ना,
हाँ हाँ,
उसका स्पीकर बंद करके रखिए आप।
वही 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 नॉर्मली वही किया था, वो हुआ कैसे आई डोंट नो। आई
मे
जस्ट
बी सम
ट्राई।
नेटवर्क इशू, आपके इधर से सम नेटवर्क
ओके।
इशू भी होता है।
अभी ठीक है?
ये सर।
नहीं, अभी भी आ रहा है।
अभी ठीक है सर।
नहीं नहीं, अभी तो बाहर निकला हूँ, 1 सेकेंड। अभी ठीक है? स्मॉल इको। परमिशंस। देखते हैं। लेट अस स्टार्ट, कंटिन्यू, फिर विल सी। ओके, सो लेट अस स्टार्ट. So what is my basic EPS? So it is essentially profit or loss attributed to the ordinary equity holders divided by, so this is the basic situation, general situation where we take the profit or loss attributable to ordinary equity holders. If there is a profit or loss from discontinuing operations, then it will be profit attributable to ordinary equity from both continuing and discontinuing operations. as well as profit or loss from continuing operations. So we are having both the, just 8 minutes, yeah, this is creating an issue. अभी ठीक है? Yes, now this is fine. All right. I'm sorry for that technical issue. Okay. So now coming to basic EPS. Ordinarily, when there are no discontinuing operations, it is going to be profit or loss attributable to ordinary equity holders of the parent entity. So this is what we do in the ordinary case. But if there is a profit or loss from discontinuing operations, so as investors, what would you be interested in? Well, I would ordinarily be interested in profit or loss from the total operations. That means continuing plus discontinuing. And I would also be interested to know what will be my EPS attributable to continuing operations. I'm not going to be interested as an investor in the EPS from the discontinued operations, because going forward, those are not going to be continued in terms of the activities. And that is why these are the two things that we have. So your basic EPS is going to be net profit or loss for the period attributable to ordinary equity holders of the parent entity, divided by weighted average number of ordinary shares outstanding during the period. Always remember, when we are computing my earnings per share, it is from the perspective of those category of equity shares which are subordinate to all other categories of shares which are there in your capital structure. That means these are the equity shareholders who are genuinely the penultimate people who are going to get the share of assets in the event of liquidation. So any other shareholder who has differential rights, who has preferential rights, we do not compute the EPS from the perspective of that. So these shares are subordinate to none in the capital structure. They are the least prioritized shares in the capital structure. All right. Now, when we talk about net profit or loss attributable to ordinary equity holders of the parent entity, what do I mean by that? This means it will be net profit or loss, that is profit or loss attributable to parent entity from continuing and discontinuing, as well as from continuing, adjusted for. We are computing from the perspective of the equity shareholder whose equity shares are subordinate to none in the capital structure. So we will be adjusting it for after tax amounts of preference dividend, if there are any preference shares in the capital structure, any differences arising on settlement of preference shares. If you go for redemption of preference shares, you end up paying a premium. So those also will come here, and similar effects for preference shares classified as equity. So these are the adjustments that we are going to do. When we talk about net profit or loss, it won't have only a P&L implication as far as the computation is concerned. You will have first part, all items of P&L, including tax expense and dividends on preference shares classified as liabilities. Why do I say dividends on preference shares classified as liabilities? Well, you've studied your financial instruments. When preference shares are classified as financial liabilities, we take the what you can say effective interest rate and compute the interest which goes in the finance cost in the P&L. So that is how you are going to do the treatment. And you have direct adjustment in reserves, where any item of income or expense which otherwise would be a profit or loss is debited or credited to securities premium or other reserves. Such item will be adjusted. Just say you have your redemption of preference shares. If this redemption of preference shares happens at a premium, for example, then we have an opportunity to utilize the securities premium for that purpose. So in that case, the securities premium so utilized represents the excess amount that you are going to pay. Now it is not hitting the P&L because we have a reserve for that specified purpose. But for the purpose of computing EPS, ultimately that surplus that you are giving in the form of what you can say premium is money which is not available to the equity shareholder who is subordinate to none in the capital structure, and that is why it has to be deducted from the net profit attributable to the equity shareholder that is computed in accordance with the P&L, right? So our computation of EPS cannot be restricted only to view the P&L. We will also have to look at possible reserve movements that happen during the period to understand correctly what is my net profit attributable to the equity holder for that particular period. Okay, and when we talk about EPS from the perspective of consolidated financial statements, it refers to the profit or loss after adjusting NCI, because obviously non-controlling interest is the non-controlling shareholder. So the earnings attributable to owners of the parent entity will be the earnings that will be left after we apportion the share to the non-controlling interest. Okay, so all clear till now? Any doubts? No doubts? Yes. So when we talk about number of shares, we basically mean the weighted average number of equity shares. Okay. Why weighted average? Why not just a simple number? Because there could be certain buybacks that could have happened during the period. There could be certain fresh issue that could have happened during the period. And when this has happened during the period, the entity has not utilized the funds that have come in or has partially utilized the funds that have got before we do the buyback. So ultimately, we are not using those funds for the entire period. They were there with the company only for a short period, and that is why we use a weighted average number where time becomes the weighing factor. So let us look at a couple of questions on that. Some of the basic preliminary questions. When we talk about numerator for basic EPS, net profit attributable, there are certain items that we will look special items. First one is after-tax amounts of preference dividends. This includes after-tax preference dividend on non-cumulative preference shares, after-tax preference dividend required for current period on cumulative preference shares, whether or not the dividends have been provided for. Okay. So I have net profit as per the P&L. This is after tax. Now, from here, I have to deduct preference dividend. Question is, how do I deduct the preference dividends? Okay. Now, this is a basic adjustment for us to understand. Currently, if these preference shares are classified as financial liabilities, the interest cost would already be factored when we are computing the net profit after tax. So this is in case of preference shares which are categorized as equity, where you could be having a preference dividend, you could be having, but that is what. So there is a small inconsistency in terms of how the standards have been drafted, because we are discussing about preference dividend, cumulative and non-cumulative. So when we talk about cumulative, the entity is liable to pay the dividend period after period. Okay, it's mandatory for the entities to pay the preference dividend. So I'm having non-cumulative. When are you going to reduce this? Only when dividend is declared. Only when dividend is declared. Why? Because this is at the discretion of the entity. If I don't declare in the current year, if I declare in the next year, and next year's EPS I'm computing, I will deduct only next year's dividend that is declared. Previous years I will not deduct because it's at my discretion. They are non-cumulative. The dividend does not get accumulated. But when I talk about cumulative, Whether or not dividend is declared, you have to do the adjustment. Okay. Dividend declared or not, adjust for net profit attributable to equity shareholders. Obviously, current year I did not declare, it is a cumulative preference share, so I will deduct. Next year, when I declare the dividend, I will declare for 2 years, the previous year and the current year. But will I actually do the deduction of 2 years? Answer is no. I will do the deduction of only 1 year, because the previous year when it was not declared, I had still considered the reduction for the purposes of computation of EPS. So dividends on cumulative preference shares paid or declared during the current period in respect of previous periods will be excluded. Why? Because this actually goes on an annual basis, so on an accrual basis. So this is one treatment which is there. Okay, so let us quickly look into one question that is there in this regard. Very simple question. So let us just understand. For now, today's questions, just ignore financial instruments. I will discuss that in detail when we have the questions. But right now, we are focused on understanding the concepts of EPS. So let us understand that and move forward. Then we will come to what are the changes on account of financial instruments. The major changes you will have is on account of application of financial instruments. So you are having net profit before tax of Mitra was 200 lakhs. Income tax rate was 37%. Preference share capital has the following classes: 12% non-cumulative preference shares, 200 lakhs. 10% cumulative preference shares, 300 lakhs. In its accounts, Mitra has paid or provided for the following dividends on preference capital. On non-cumulative preference shares, it is fully declared for the current year. Non-cumulative declared. So do you reduce? Answer is yes, because it is declared in the current year. Cumulative preference shares fully provided for the past 3 years. Now, will you consider for the entire 3 years? Answer is no, because they're cumulative. You would have considered 2 years in the previous periods. So only what is pertaining to the current year is what you are going to include. Company also provided for dividend distribution tax at 12.75%, transferred 10 lakhs to general reserve. So you are required to calculate the net profit for the period attributable to equity shareholders. Okay. Is 10 lakhs to general reserve going to be deducted? Answer is no, because that is only appropriation which we are moving into a separate reserve. Do I have to deduct preference dividend on the non-cumulative shares? Answer is yes, because it's provided in the current year. On the cumulative, only what is pertaining to the current year. So you have your PAT 200 lakhs. You have your tax expense 74 lakhs at 37%. So you are left with you have PBT 200. So your PAT is going to be 126 lakhs. Out of that, we are going to deduct dividend on non-cumulative shares 12%. So you are having 12% preference share capital 200 into 12%, 24, and on cumulative preference shares 10%, 300 lakhs only for the current year, So 30 goes deducted, and since we are paying the dividend distribution tax, so that is also not going to be attributable to the equity shareholder. So we deduct that as well. So your net profit attributable for equity shareholders is going to be 65.115 lakhs. Dividend on cumulative preference shares for prior years and transfer to general reserve, you will be ignoring under Ind AS 33. Okay. So that's a fairly simple adjustment. Let us move on to the next one. Okay, treatment of certain items in computation of numerator for basic EPS. Okay, so in this one, we are having second one, increasing rate preference shares. What do you mean by increasing rate preference shares? Initially, there will be a reduced dividend. There will be a reduced dividend that will be paid. Why reduced dividend? Because I have issued the shares at a discount. I have issued the shares at a very low value. And that is why I will not pay the dividend in the initial years. Later on, when the entity starts generating profit, we can go for above the market dividends in the later periods. to compensate for whatever dividends I have not paid initially. So if I have to look at the graph, initially there won't be any dividends, but later on your dividends will start to rise. Later on, your dividends will start to rise. So it is in this period that you essentially do not have any dividend. But in this period, what are you having? The shares themselves get issued at a discount. The shares themselves get issued at a lower price. So this is how we are having your treatment. So now, how do I do this treatment for the purposes of EPS? We will record an original issue discount or premium amortized to retained earnings using effective interest method and treat as a preference dividend for the purpose of calculating EPS, irrespective of whether such discount or premium is debited or credited to the securities premium. Okay, so this is, let us look and understand with the help of a question. Yes, you can understand better. Company issued non-convertible, non-redeemable, Class A cumulative preference shares of rupees 100 par value at the beginning of year 1. These shares are entitled to a cumulative annual dividend of 7 per share starting in year 4. That means years 1, 2, and 3, are you going to get dividend? Answer is no, 0 dividend. Then you are going to get 7 rupees per share. At the time of issue, the market rate dividend yield on such shares was 7% per year. So compute the following issue price of preference shares and treatment for computation of EPS. So issue price, see, this is just a calculation that is explained. Okay, there are certain things where again you apply financial instruments, there will be a particular conflict. I'll explain what that conflict is. First, let us look at how the working goes about. Okay. Present value of 100 discounted at 7%. This is the market rate dividend yield on such shares. So we are discounting it to 7% for 3 years. So that comes to 81.63. So what is happening here? A share of 100, I am issuing at 81 rupees. And I will not be paying the dividend for a 3-year tenure. So I'm giving a discount now and I'm telling the shareholder, I'll not pay you any dividend currently. I will pay you the dividend in the 4th year. So the shareholder will ask, how are you compensating me? Well, I'll give you a discount. I'll give you a discount. So you are giving a discount of 18.37 per share. How do I do the treatment under Ind AS 33? Well, this is the effective interest calculation that you always have been doing in financial instruments. So 81 plus 7% imputed dividend, which is there, gives you the carrying amount before dividend, 87.34. So this becomes 100 by end of year 3. And then thereafter, you are having 100 dividend imputed therein is 7. So 107, and then you issue a dividend of 7. So it falls back to 100. So this is a very simplistic calculation that happens. The problem with this is, have we ever seen a discounting in the case of equity shares? Have we ever seen a discounting in the case of preference shares, which are normally, see, what is the treatment? It is non-redeemable. That means it is not convertible into cash. Non-convertible does not have any meaning when we look at the definition from a financial instruments perspective. See, we don't merely look at the name, we look at the substance of the transaction. The fact is it is non-redeemable. Non-redeemable means you are not going to get money at the end of the period. If you are not going to get money at the end of the period, what is the nature of this instrument? Is it a financial liability? Do you have an obligation to deliver cash? Answer is no. Since you do not have an obligation to deliver cash, how is it going to be? This is going to be more in the nature of equity. This is going to be in the nature of equity. In spite of this conflict, we have this particular treatment that is there. It is purely academic in nature. This is directly taken from the Ministry of Corporate Affairs standard that has been there. You can check up. This example also is there. So you are having this treatment which is there. So it's purely academic, but it does conflict with our understanding of financial instruments. Okay, so with that, that is your increasing preference dividend. So whatever is amortized to retained earnings, you will obviously take it as a reduction. You will obviously take it as a reduction. Okay, it could go to retained earnings directly, it could go to securities premium directly, it doesn't matter, but you will be taking it as an item of adjustment for EPS. Okay, all right. Now, repurchase of preference shares. Repurchase of preference shares at a premium under tender offers to holders. Suppose you are paying preference shareholders a premium, excess of fair value of consideration paid to preference shareholders over the carrying amount of the preference shares. What does it represent? It represents that you are giving something additional to the shareholders, to the preference shareholders. So it is a return that you are giving to them. It is a return over and above their amount that they have invested. So who is ultimately contributing for these? Who is ultimately contributing for this return? So this return is contributed for by the ultimate shareholder because his available profit goes down on account of such return given to the preference shareholders. So what do? A return to the holders and I charge off to the retained earnings of the entity. I normally do not take it into the P&L. I charge it off to the retained earnings और securities premium as the case may be P&L में नहीं आता है. But how do I treat it for the purposes of EPS? I have to deduct it in calculating profit or loss attributable to ordinary equity holders of the parent entity. This treatment I will have to do because ultimately what is happening? Ultimately, we are having these profits reduced. We are having these profits reduced for the ultimate shareholder. We are having these profits reduced for the ultimate shareholder. Is it okay? Yes. Are you having any doubts on this? Anybody? Yes. Shall we proceed further? Yeah. No doubts? Anybody has any doubts? Okay. So let us proceed. Okay. So we come to certain questions which are there in your study module in this regard. So page 10. Okay. ABC Limited had issued preference shares at 100 rupees each 10 years ago. Okay. Now it does a buyback for 120 each. So we have paid a premium. Premium gets charged to retained earnings. It does not hit the P&L. No amount is recorded in the statement of P&L. Agreed. However, for EPS purposes, you are paying something extra. That something extra comes at the cost of the ordinary shareholder. So you are going to charge, you are going to take 20 as a reduction for the purposes of the computation of EPS. Fairly simple. Okay. So that takes care of example 5. Okay. All right. Early conversion of preference shares. Early redemption or early conversion of preference shares. Okay. Now, let us take this particular case. Okay, I will explain. Okay. Early conversion, redemption of preference shares. Okay, there are two situations that can arise. There are two situations that can arise in this regard. Okay, now preference shares classified as equity, classified as liability, we pay a premium for early redemption. It is to be redeemed after 5 years. 3 साल बाद I notice I have sufficient cash. I will call the preference shareholders and ask them, look, I have to pay you after 5 years. I am in a position to pay you now. So I am going to give you an incentive for early redemption. So the shareholders, the preference shareholders will say, fair enough, you can redeem it and give us the premium. So this premium, usually you take it to securities premium account. Usually premium taken to securities premium. Okay. Regardless of whether you convert or whether you redeem, doesn't matter. But the premium goes to the securities premium, and such premium, ideally, it would go and sit as a finance cost. Ideally, because they're classified as a liability, it goes and sits as a finance cost, right? EPS implication. Okay. It's already part of your finance cost. वो P&L में आ जाता है. Okay. So EPS implication. Will you do any specific activity for this? Will you do any specific activity for this? Answer is no. Deducted while computing NPAT, net profit after tax. Why deducted? Because this is in line with the fact that it has gone into finance cost. Hence, no further deduction is required. Okay. When you are classifying as equity, and early conversion karoge, then what happens? Premium taken to securities premium or retained earnings. Acha. The premium that you give here, will it be classified as a finance cost? Answer is no, because your preference shares themselves are in the nature of equity. So there cannot be a finance cost. Okay. So this will be transferred to securities premium or retained earnings. It is not forming a part of your profit and loss. So your EPS implication for this will be what? Your EPS implication for this particular case will be deduct from net profit to determine net profit attributable to equity shareholders. Why? Because such premium would not have been deducted while computing the net profit. Are we able to understand the difference between these two? Preference shares classified as a liability, the premium goes and sits in your P&L because it becomes a finance cost. But in the case of preference shares classified as equity, there is no question of finance cost. So whatever premium you pay will be outside the P&L in the retained earnings or securities premium. You deduct it. Are we clear with this? Yes. Any doubts? Any doubts? No doubts? Yes. Abrakesh is there? Yes. All clear. Manish, all clear? Okay. All right. Fine. Let's proceed. Early conversion. Okay. So ye ho gaya. This is what we have done. So let us proceed. So this we have done. All right. Now you can go through this question for homework. I will proceed further. You can go through this question also for homework. I will do certain other questions. Okay. All right. Denominator, weighted average number of equity shares. So we are basically going to determine the time weighted number of equity shares. Okay. So that is what is there in this particular discussion. So a couple of simple questions. In a financial year, Ravi Limited issued 80 lakh equity shares at par on 15th December. It had also bought back 20 lakh rupees at par on 1st March. Equity capital was 150 lakhs at the end of the year, 31st March. Calculate the weighted average number of equity shares outstanding if the face value is 100 and also compute the basic EPS. Simple question. So you are having opening capital of 90 lakhs because you are given the fresh issue, you are given the buyback, you are given the closing balance. So how do I compute weighted average number? Well, on 1st April, you are having totally 90,000 equity shares. These shares were present for the entire tenure of 12 months, so 90,000. 15th December, what did I do on 15th December? It has issued 80 lakh rupees worth equity shares. That means 80,000 shares are in existence for 3.5 months. Half of December plus Jan, Feb, March. So 3.5 months. So 23,333. And last one is on 1st March, I do a buyback. Bought back rupees 20 lakhs of equity capital. So I do a buyback. That means these shares were not present for 1 month. So 1 month as a reduction we show. So 1,11,667. This is what is the manner Institute has always presented in its solutions, which is correct. Okay. Alternatively, what you could do is you could look at a timeline form of presentation. Choice is yours. Both give the same answer. Okay. So you had 90,000 shares at the beginning. On 15th December, there is a further addition of 80,000 shares. So it becomes 1,70,000. On 1st March, there is a reduction of 20,000 shares. So it comes to 1,50,000. So 90,000 was effectively there for 8.5 months, 1,70,000 for 2.5 months, and 1,50,000 for 1 month. So if you do the weighing for the time, so 90,000 into 8.5 by 12, 1,70,000 into 2.5 by 12 and 1,50,000 into 1 by 12, you get the same answer. Reason why I would prefer a timeline approach is chances of skipping any adjustment is very remote. Chances of skipping any adjustment is extremely remote. Okay. All right. So I would suggest to go through this question number 4 also for homework. This is uploaded. Yes, this is uploaded, so you can go through it. All right. Now, coming to partly paid shares. How do I do the treatment? Well, whatever is paid, whatever proportion is paid, I will multiply the weighted average number by that proportion because that is the amount of cash which I have realized. Remaining to I have not called also. And I may have called, I would not have received also. So therefore, you are going to consider only that proportion which is paid in determining the weighted average number of equity shares. So you are having this particular question. We will just look into that question simple. During the year ended 31st March, Giant makes a public issue of 1 lakh equity shares of 10 each. The calls were made as rupees 5 on application and allotment, rupees 2 on the first call, rupees 3 on second and final call. Partly paid shares are entitled to participate in the dividends to the extent of the amount paid. Company had 5 lakh shares at the beginning of the year. Apart from public issue of shares made above, there were no changes in the share capital. Compute the weighted average number of equity shares. Okay. 1st April, we are having 5 lakh equity shares. These were there for 12 months in totality. So 5 lakh becomes your basic computation for the shares that were there in the opening balance. On 1st July, I have made a fresh issue of 1 lakh and amount to be paid on application allotment is rupees 5. So 1 lakh. So out of 10 rupees each share, 5 is being paid. So 50%. So this is going to be 1 lakh into 50% because only half has come. So 50,000 into 9 by 12. This happened on 1st July. So that comes to 37,500. On 30th September, another 1 lakh. So how much did I make a call? 2 rupees. So 1 lakh into 20%. I got 20% of the amount. So total amount with effect from 30th September is 70%. So this will be for a period of 6 months. And last 3 rupees, I made a second and final call on 1st January. So 1 lakh into 30% for 3 months, 7,500. So you are going to get your weighings as 5,55,000. 5,55,000. Any doubts so far? Any doubts? No doubts. Okay. So I leave question number 5 for homework. Similar question. You are having equity shares outstanding, issue partly paid, buyback, issue of shares fully paid, and then preference dividend, net profit before tax. So that's it. So you can do the computation of this yourselves. Okay. All right. Next. Let us start. Let us look at this one. At the beginning of a financial year, company issued 1,20,000 equity shares of 100 each. 50 per share was up on that date, which was paid by all the shareholders. The remaining 50 called up on 1st September, all paid except one shareholder holding 24,000 shares. Net profit is 2,64,000 after dividend on preference shares. Compute the basic EPS. Okay. So let us look at that. 1,20,000. 50% only was paid up to how much? The next call was made on 1st September. So this is up to 31st August. So 5 months up to 31st August, 5 by 12. So 1,20,000 into 50%, 60,000 into 5 by 12. 60,000 into 5 by 12, you get your weights as 25,000. Then 1st September, you make a call. And out of that, 24,000 did not pay anything, but 96,000 shareholders paid. So 96,000 becomes fully paid for a period of 7 months. So it comes to 56,000. Whereas 24,000, they did not pay. So for 7 months also, it is at 50% only. So 7,000. So your weighted average number of equity shares is 88,000. Weighted average number is 88,000. All right. Fine. Yes. Any doubts so far? Anyone? Anyone? Any doubts? No doubts. Manish? All okay? Yes. Please confirm. All well? Okay, fine. So let us proceed further. So you can look at illustration 3. Let us look at what is the question. It looks to be a similar one. The following is the data for company XYZ in respect of number of equity shares during the financial year. Opening balance is given, fresh issue is given, conversion of convertible preference shares into equity is given, buyback 20,000, closing balance of outstanding equity shares. So you are fairly aware of this, right? So all that you need to do is do the mathematical calculation. That's it. So I leave this for homework. There is no change in this. We did this question. We did, yeah, we did. I told you to do this for homework. We did this question. We did this also. So you are in a position to do this. Okay. Now the question is, for specific scenarios, what will be the date I will consider for the purposes of weighted average number of equity shares? Just say I come out with a call that I have made on the shares. Now, when I make a call on the shares, some shareholder will pay on some date, another one will pay on a third date, somebody will pay 1 week afterwards. So there is a huge number of payments which will keep coming in respect of different shares. For example, okay. Now, when you make a fresh issue first time for the full amount, how am I going to recognize it? Okay. So all these things we have certain guidance from the standard. So when it is in exchange for cash, timing will be considered from the date the cash is receivable. It's not talking about receipt of cash. It is saying when did the cash become receivable? From that day onwards, you are going to do the calculation of, you are going to consider the date for the purposes of weighted average number of equity shares. On voluntary reinvestment of dividends on ordinary or preference shares, the date when they are reinvested. Sometimes you convert your debt to ordinary shares, the date when interest ceases to accrue. That will be the date it officially becomes equity. In lieu of interest or principal on other financial instruments, well, when the interest ceases to accrue. Okay. In exchange for settlement of a liability, the date of settlement will be the date you will consider for weighted average number. As consideration for acquisition of an asset, the date when the acquisition is recognized. For rendering of services, you are going to pay them equity, the date when the services are rendered. As part of consideration transferred in a business combination, it will be with effect from the date of acquisition. All right. So this is what are some of the situations that you are having. Upon conversion of a mandatorily convertible instrument, the date when the contract is entered into. Bonus or share split, this is important for us. Bonus or share split beginning of the earliest prior period reported. Contingently issuable and returnable shares, we will be checking this out tomorrow. We will be looking at this tomorrow. Partly paid shares, we have seen just now. What are you going to do? Treat it as a fraction of the ordinary share to the extent they are entitled to participate in dividends relative to a fully paid ordinary share during the future, during the reporting period. Completely vested options. Completely vested options, they cannot be regarded as shares remaining outstanding, hence not included in computation. Similar to contingent shares. For diluted EPS, we will look at all these things later on. Okay, all right. So that takes care of the dates. Let us look at a couple of questions in this regard. Okay, so come to your sheet. On 30th June on 30th June, Bharat merged into Anand from the following relevant information. Compute EPS of Anand at the year end, that is 31st March. Okay, fine. Net profit from date of merger till year end, 5 lakhs, 2 lakhs. Net profit earned until merger, Anand has earned 8 lakhs. Number of shares rupees 10 each at the start of the year on the date of merger and at the year end. So how am I going to do the working? Okay. Well, total profits for the year of the combined entity will be 8 lakhs. Yes. It will be 5 lakhs and it will also be 2 lakhs because they are essentially one entity only. So this becomes 15 lakhs divided by weighted average number of shares. So what is your weighted average number? Well, at the start, I'm having 6,000. So 6,000 into 3 by 12 till 30th June. Then you have taken over the entity. So on the date of merger, it was 6,000. But by the end, at year end, it is 10,000 into 9 by 12. So 9,000. So 166.67. See, these are all just to make you familiar with the way we do the computing. This is just to make you familiar with the way we do the computing. Okay. So that is more important. Coming next. Okay. What about assets? You have purchased an asset and issued equity shares. From which date will you consider for weighted average number? Well, from the date the asset acquisition is recognized. So Bhaskar issued 8 lakh equity shares of rupees 100 each. During the year ending 31st March, company acquired an asset on 1st December for 25 lakhs, issued 1 lakh equity shares treated as rupees 25 paid up. At the beginning of the year, the equity capital was 5 lakh shares. Compute the basic EPS if the net profit is 37.5. So 8 lakh shares of 100 each issued. During the year, it acquired an asset, issued 1 lakh equity shares at par. So let us understand. So this is, yes, all right, 5 lakh opening. So 5 lakh opening there for an entire period of 12 months. So 5 lakhs. 8 lakh you issued on October 15th. So this is there for 5.5 months. So 3 lakh 66, 667. 1 lakh equity share, you are issuing it as partly paid. You are issuing it as partly paid. Yes. So how do I do that? Into 25%. So for a period of 4 months, December, Jan, Feb, March. So that comes to 8,333. So total is 8,75,000. Total is 8,75,000. Shares issued are recognized with effect from the date of recognizing the acquisition. So basic EPS is 37,50,000 by 8,75,000. So that comes to 4.29 per share. Okay, very simple. No doubts on this. Okay, no doubts on this. All right. Now let us proceed further. Any doubts so far? Done. Any doubts so far? Anyone? We did this. We did this. Okay. Any doubts? Students? No doubts? Questions? All clear? Yes. Yeah. Okay, fine. So let us continue. You can look at illustration 17, which is there in your study module. Entity issues 1 lakh ordinary shares for a consideration of 2.5. Cash of 1.75 only was received. Entitled to participate proportionately to what they have paid in the dividends that are issued. So calculate number of shares for the purpose of basic EPS. I want you to do this as a homework. We have done ample questions, 2-3 questions we did. So I think you should be in a position to do this also. Okay. Now, coming to the next one. And this is where it starts to get important. Okay. Issue or reduction of shares without a corresponding change in resources. Issue or reduction without a corresponding change in resources. That means what? Your equity share capital has increased or your equity share capital has decreased, but neither you got any money nor you paid any money. How can that happen, sir? Well, bonus issue could be there, or you could do a consolidation, a reverse share split, or it could be just a share split where you are dividing the share into multiple, what you can say, multiple number of shares. So all these are essentially change in the number of shares. But am I getting any money for that? Answer is no. Am I paying any money for that? Again, the answer to that is no. So how do we do this? See, the weighted average number of ordinary shares shall be adjusted for events other than conversion of potential ordinary shares that have changed the number of shares outstanding without a corresponding change in resources. Too technical a language, but let us understand with the help of an example. Okay. Now, compute basic EPS, beginning of the period 5 lakhs. Bonus issue 3 for every 1 share held. So net profit for the current financial year is 160 lakhs. Net profit for previous financial year is 50 lakhs. If the standard guidance was not there, how would I have done the working? Well, I would say previous financial year 50 lakhs divided by how many shares did I have? 5 lakhs. So that would be rupees 10 per share. That would be rupees 10 per share. Coming to the next, profit for the current financial year, I would take 160 lakhs. Bonus issue would be how much? Bonus issue would be 3 shares for every 1 share held. I am holding 5 lakhs, so 5 lakh would become 5 lakh into 3, that is 15 lakhs. So 15 lakhs would be the bonus share. So what you would be doing is, you would say, look, I have 5 lakh shares in the beginning, okay? And now I am getting 15 lakh shares into 6 by 12 divided by rupees 160 lakhs. So this would be 15 lakhs into 6 by 12, 7 lakh 50, so 12 lakh 50. So 160 lakhs divided by 12 lakh 50 would effectively give you an EPS of 12.8 per share. This is how you would have done the EPS if guidance was not there. Now the question is, the shareholder will ask, look, your profit has gone up by 3.2 times. Your profit has gone up by 3.2 times. And if that has gone up by 3.2 times, why is your, why is your EPS only going up from 10 to 12.8? That is one mismatch that the shareholder will immediately see and notice. Yes or no? That is one mismatch they will immediately see and notice. And therefore, the standard says, look, we cannot have such aberrations, because technically speaking, there is no change whatsoever in the capital structure. Only thing is, you had 5 lakh, now you are having 5 plus 15, that is 20. So what the standard has said is, if you are having shares that are issued by way of a bonus, that means no resources have come in, you will treat as if these bonus shares were always there in existence. That means 160 lakhs divided by bonus is already in existence. What is the entry that we pass for bonus shares? Well, it will be reserves account debit to equity share capital. You are only capitalizing your reserves and nothing else. So rupees 160 lakhs divided by 20 lakh equity shares, divided by 20 lakh equity shares. So that comes to how much? That comes to how much? That comes to rupees 8 per share. That comes to rupees 8 per share. But look at the reader of financial statements. He will look at last year. Rupees 50 lakhs. Okay. Divided by, he will look at number of shares of the last year. So 5 lakhs. And then he will say, look, rupees 10 per share. Then he will look and say, look, rupees 10 per share is what is my basic EPS of the last year. And then the investor will ask you a question. Your profit went by 3.2 times. Your profit went by 3.2 times. Why is your EPS falling? Why is your EPS falling? 10 became 8 when actually your profit has gone up. So why has it reduced? So this has reduced because you have a bonus issue in the current period. So what are you going to do? You are going to restate last year's EPS also, because they have to be truly comparable. Okay. So if that is the case, then we will have 50 lakh divided by 20 lakh shares, divided by 20 lakh equity shares. So that comes to how much? 20 lakh equity shares. So that comes to rupees 2.50 per share. 2.50 per share. Are we okay with this? Yes, are we okay? So 2.5 has become 8. So this again represents a 3.2 times increase in EPS. Increase in EPS, which is exactly the increase that you have noticed in the net profit for the financial year, current versus previous. Yes, are we okay? Any doubts on bonus? So I will not only restate current years by ensuring it is taken for the full year, but also of the comparable periods. Any doubts? No doubts. Okay, fine. All right. Okay, Sumit, any doubts? Sumit is there. Okay, fine. What about Manish? Any doubts? No doubts on the portal? No doubts. Okay. So this is the reason why we are doing a retrospective restatement also in my figures. So that is the situation for bonus. Coming next, we have a similar question. At the beginning of the reporting period, Advait Limited's equity capital was 10 crores divided into shares of 10 each. During the financial year, it has issued bonus shares in the ratio of 1:1. Net profit for the previous and current financial year, 8.5 and 11.5 crores respectively. EPS disclosed in the accounts for 2 years is 8.5 and 5.75 respectively. This is what is the reported EPS. Comment on the EPS calculated above. So, in the current period, we have net profit for the year coming to how much? 11.5 crores. Current financial year, 11.5. Bonus shares in the ratio of 1:1. So I have 10 crore worth of equity share capital of rupees 10 each. So my number of shares are 1 crore. So bonus plus existing capital becomes 2 crore equity shares. Becomes 2 crore equity shares. So 11 crore 50 lakh by 2 crores, this is 5.75. So this number that is reported is correct. This number that is reported is correct. But can I do the restatement only for the current period? Answer is no. I have to do the restatement for the previous also, because these shares will be deemed to be in the capital structure right from the inception. So therefore 8.5 crores divided by 2 crores, we get 4.25. But what have they reported? They have reported 8.5. So how did they get 8.5? Well, that will be 8.5 crores of profit divided by 1 crore equity shares. So they have not done a restatement. They have not done a restatement. The company has not restated the previous year's EPS in line with Ind AS 33. Okay. So that takes care of bonus. I hope there is no doubt. So this is the first thing that we have seen, bonus issue. That means there is no change in resources, but there is a change in the number of equity shares. So we do a current year as well as a previous year, we do a restatement for the purposes of financial reporting. Coming to the next one, that is rights issue. Coming to the next one, that is rights issue. Rights issue is an issue that is made to the existing shareholders, typically at a value that is lower than the market rates. Typically at a value that is lower than the market rate. So the understanding that is there is, in the rights issue, there continues to be a bonus component also that is involved. That is why you are not getting shares equivalent to the market price. You are issuing more. So when I convert it into the market value of the shares, your actual shares for which you have received the resources will be less, and the difference will be the bonus component that is there. So I will take you through two ways of looking at it. First one, what we need to do academically for the purposes of the examination. And second one, what is the reasoning behind applying that particular concept. So you can then look at either of the methods of solving. The solutions will not differ in that regard. Okay. So now the following information is furnished by Samantha Limited for the financial year 1920 and 2021. Okay. Net profit for 1920, you are given 22 lakhs. For 2021, you are given 30 lakhs. There is a rights issue of one share for every 5 shares outstanding. Okay. Number of shares outstanding prior to rights, 10 lakh shares with a rights price of rupees 25, with a rights issue price of rupees 25. Fair value of one share immediately prior to exercise of rights, 32. Last date to exercise the rights is 31st July 2020. You are required to compute basic earnings for 1920. You are required to compute the restated basic earnings for 1920 for rights issue. And you are required to compute the basic earnings per share for 2020. Okay, so these are the three things that we need to compute. So 1920 basic, 1920 restated, 2021 basic earnings per share. Okay, so these are the three things we need to do. So first one, let us start with computing all these figures, but we'll do some workings for that. So now there is a stepwise approach that we have to adopt when there is a rights issue that has happened in the current period. So how do we do that stepwise approach? First one is we calculate something known as theoretical X rights fair value or price. That means excluding the rights, what will be the value of the share? So how do I do this? Well, I have how many shares prior to rights? I have 10 lakh shares. What is the market value? This is 32. Against a share of 32, I am issuing against 5 shares of 32 each. I am issuing how many shares? I am issuing 1 share of 25. So against 10 lakh shares, I am issuing 2 lakh shares at 25 divided by 10 plus 2. Alternatively, what you can do is instead of taking the entire shares, you can take the ratio. Answer remains the same. So 5 shares into rupees 32. This is the existing market price before the rights. Plus you are having, you will be getting 1 share of rupees 25. You will be getting 1 share of 25. So after the rights, how many shares will you be having? 5 plus 1. You will be having how many shares? 5 plus 1. So that comes to 32 divided by, that comes to how much? Sorry, that comes to 30.83. That comes to 30.83. This will be the same. It's just a ratio. So this is your theoretical X rights value. This is your theoretical X rights fair value or price. Now, the next step that you are going to do is the adjustment factor. What is my adjustment factor? Fair value before the rights issue divided by theoretical X rights price. So 32 divided by 30.83. 32 divided by 30.83, 1.04. 1.04. Okay. I'll explain that. I'll come to your query, Abrikesh. Just give me 5 to 10 minutes. I will explain this working, then we will look at the reasoning behind following this working, and then I hope that you will be able to understand the whole mechanism. Okay. So adjustment factor is 1.04. So weighted average number of equity shares which are outstanding during the period pre-rights issue, we multiply it by the rights adjustment factor. So for a period of 4 months, my number of equity shares were 10 lakh. I multiply with the rights adjustment factor of 1.04. There is a decimal, so I have just written it as without rounding it off. So it comes to 3,45,946. After the rights issue, how many shares am I having? I am having 12 lakh for a period of 8 months. So that comes to 8 lakhs. So 11,45,946 is your weighted average number of equity shares. So your basic for 2021 is going to be 30 lakhs profit divided by 11 lakh 45,946. So this comes to 2.62. What was the reported number earlier? 22 lakhs divided by 10. So that comes to 2.2. I'll come to the restated value shortly. But let us understand why am I having this right adjustment factor that is being done, or what is the reasoning behind doing this kind of a working. Okay, so now rights issue. Okay. How many shares did I issue under the right? Number of shares issued under rights is equal to 2 lakh shares. At what value? Sir, this is at rupees 25, the issue price. Okay. But what is the fair value? What is the X rights value that we determined? Sir, that is 30.833, if you recollect. That is 30.833. So now you have received, amount received is equal to rupees 2 lakh into 25. So that gives you 50 lakhs. But against 50 lakhs, the fair value should be how much for this? The fair value should be 30.833. Yes or no? 30.833. You have issued for 25 because it is a rights issue. So that difference between 30.83 and 25, that 5 point whatever is there, that becomes a bonus component for us. So in effect, when you get 50 lakhs, the number of shares which go at the fair value level is 50 lakhs divided by 30.833. So that comes to how much? 50 lakhs divided by 30.833. This comes to 1,62,162 shares. You may have issued 2 lakh shares. Nobody is denying that. But fact of the matter is, in fair value terms, you have only issued 1,62,162 shares. Sir, what about the balance? The balance number of shares represents your bonus component. The balance number of shares represents your bonus component. Therefore, bonus component is equal to 2 lakhs minus 1,62,162. So this comes to 37,838 shares. And now, how do we do the calculation? Because now it is very simple. It is like saying, this is first, this is 1st April, 31st March, 31st July. It is like saying, I had how many shares in the beginning? I had 1 crore shares in the beginning. Okay. This one. I had 10 lakh shares in the beginning. So 10 lakhs. On 31st July, I am issuing 1,62,162 shares, which is the fair value that I have issued the shares for at fair value. And I have additionally issued plus 37,838 shares bonus, plus 37,838 shares bonus. So what is the rule for bonus? These shares are already deemed to form a part of capital structure right from the inception. Whereas the remaining shares where the resources have come in at fair value, you will do a weighted average for time. So how am I going to compute the weighted average number for this? So weighted average number is going to be 10 lakh is there for entire 12 months. 10 lakh is there for entire 12 months. Plus 1,62,162 came into existence on 31st July. That means it was not there for 4 months. It is having its presence for 8 months only. 162 into 8 by 12 plus 37,838 is the bonus component. This bonus component also is deemed to be in existence for the full year. So 37,838 into 12 by 12. So this comes to 10 lakhs plus 162 into 8 by 12, 108 plus 37,838. So that comes to how much? 10 lakh plus 1,08,108 plus 37,838. It comes to exactly 11,45,946 shares. Are we okay with this? Yes. Abrikesh, did you follow? Yes. Did you understand the reasoning? Manish, any doubts? Yes. So this is exactly what we have tried to do when we did the rights factor, when we did calculation of the rights factor. How did I calculate the rights factor? Market price before was 32. X rights price is 30.833. So 32 divided by 30.833 is nothing but 1.037838. When we remove the last decimals, it becomes 1.04. But are you able to see what is this 1.037838? This is the bonus component. This is the bonus component, which is nothing but 37,838 divided by 10 lakhs, which is nothing but 37,838 divided by 10 lakhs. Are we okay with this? So this becomes your bonus component. So now what you have to do, all the shares prior to the issue of rights, I will multiply it with the bonus component. And after the rights, I will not multiply, I will take total number of shares, 12 lakh, and do the calculation. So if I further take the timeline, for simplification, it will look like this. 1st April, 31st July, 31st March. We had 10 lakh shares here, if you remember, and 37,838. So 10,37,838. 37,838 is my bonus. So this is nothing but 10 lakh into 1.037838. 1.037838. And this 1.037838 is nothing but my rights factor. Is nothing but my rights factor. Going forward, how am I doing? Well, going forward, I have 10 lakh shares. I have 1,62,162 shares. That is the issue that is at fair value. And I'm having 37,838 shares bonus. So this comes to how much? 12 lakh shares into 8 by 12. Are we okay with this? So have I considered bonus entirely? Answer is yes. This is into 4 by 12 into 4 by 12. Is the bonus element considered for the full period? Answer is yes. I considered for 8 months and I considered for 4 months. 10 lakhs have you considered for full 12 months? Answer is yes. 10 lakh for 4, 10 lakh for 8. The rights issue that has happened at fair value, those number of shares are considered for a tenure of 8 months only, which is why instead of doing it this way, you are having that rights factor calculation. Any doubts, Abrakesh, now with respect to what we did? Yes? One second, I'll just unmute. All right. Yes, Abrakesh, tell me.
Good morning, sir.
Good morning. Good morning.
Sir, I am not able to digest the earlier logic where you have added right issue components for considering X right number of shares, weighted average, where you have added 10 lakhs plus 2 lakhs into.
Wait. You are telling this calculation, right?
Sir,
This is
my
the-
doubt is sorry, sir. My query is ki, had we not declared right issue, then the condition would have been different. So why after right issue in the beginning there will be a number of equity shares will be 10 lakhs plus that 37,738 bonus component.
Okay. So your query is how did we get 37,800?
No, not that. Why in this step 1?
Okay.
For X right value or
Yes.
determination of theoretical X right fair value,
Yes.
why we are adding right issue components, right issue plus issue price?
See, we are doing this because this is the theoretical X rights price. That means once the rights issue is done, once the tenure of rights issue is done, once the rights issue is complete in totality, what will be the price of that share thereafter? What will be the price of that share thereafter is what is the calculation that the standard requires. Okay.
I got it, sir. So it's a calculation for X right stage. It's not the before value of before right issue.
No, it is not before rights.
Okay, got
because you are doing it once the rights issue ends. Once the rights issue ends. Are we okay now?
Yes, sir.
Okay. So the overall reasoning is understood. So I hope there is no query that is there in this now. Okay. All right. I had taken one. I'll just go back to one of the earlier things what I had done. Okay. Just allow me to take you through this. Okay. All right. Yeah. Okay. I'm running you through one of the rights issue that has actually happened, and there we can understand how the whole calculation actually works. Okay. So all right. So there is this company EIH Limited, which came out with a rights issue in the year 2021. So we will do the question starting right from 1920, how the reported numbers were arrived, 2021, how did we determine the EPS, and 1920, how did we do the restatement, and how do I do the rights calculation in this case. Okay, so this is just for you to understand the application of this. Okay, so now let us understand how this has happened. So coming to 1920, your reported profit is 1,244.67 million, and the number of shares that were in existence is 571,569,000. So that comes to a reported EPS of 2.18. There were no issue during that period, so it is a straightforward calculation. 1,244.67 million divided by 571,569,000. So that comes to 2.18 rupees per share. That was your reported basic EPS. There is no doubt on this. Now let us come to the next. That means 2020-21, when there is a rights issue that has happened. Now let us understand the terms of the rights issue. Let us now understand the terms of the rights issue. Okay. Okay. This is for the year 2021. You are given this data. I hope it is visible. During the year, the company raised a capital by issue of further shares to eligible equity shareholders. Issue of further shares to eligible equity shareholders on a rights basis. So there is a rights issue in the ratio of 8 shares for every 85 shares held. In the ratio of 8 shares for every 85 held, the shares were issued at a price of 65 per share, including a premium of 63. So the face value is 2, premium is 63, the rights price is 65. So how many shares did it issue? The company issued 53,795,000 approximately, these many shares aggregating to 3,497 million. And they have explained the purpose for this. The capital was raised for repayment of short-term and long-term loans. The trading permission for the right shares were received from BSE and NSE on October 27, 2020, and from the Calcutta Stock Exchange on 2nd November 2020. So this is the information about the rights issue that has happened. So I have tried to capture it in a summary for you. The issue price is 65 per share. 8 shares issued for 85 shares held. Details are given on so and so page. Okay. So now we have how many shares? Opening is the same number. You can check. Yes. And I have issued how many right shares? You can check here in this particular note. 537, 94, 768. Are we okay with this? So closing number of shares is 62, 53, 64, 182. 62 crores, 53 lakh, 64,182. Now, what I have done is, I just tabulated the market price of this EIH Limited shares around the market, around the rights issue. So we are having rights offer opened on 29th September when the market price was 81.85. The rights offer closed on, that is the last date for exercise of rights, was 13th October 2020 when the price was 76.2. The allotment date of the rights issue happened on 20th October when the price was 75 point something. The record date and the date that is just prior to the record date. Okay. So when I did the rights issue, this is the journal entry that would have been passed. This is just for our understanding and explanation. Now let us come to the understanding of the workings. Theoretical X rights price works something like this. I had 85 shares at 76.2. What is 76.2? The price of the share before the closure of rights. Just before the closure of right, it is 76.2. So 85 into 76.2 against each share of it, against 85 shares, how many right shares am I issuing? I am issuing 8 shares. At what price? At 65. So what will be my X rights price? It will be 75.24. So your rights adjustment factor is 1.01281. 1.01281. Are we okay with this? Yes, are we okay? Any doubts so far? No doubts? Is this okay? Yes. All right. Now, coming next, 20th October was your allotment date. 20th October was your allotment date. That means till 19th October, you had only the basic shares that were there right from the beginning. So number of shares, this is what is the opening, 57, 15, 69, 414. Number of days, 202 from 1st April till 19th October. And rights adjustment factor 1.01281. So you are having all the previous period. I am multiplying it by the adjustment factor because your bonus component will get included in that. So that gives you 320371,247. And the remaining 163 days, that means from 20th October to 31st March, when the right shares have officially come into the capital structure, you are having 163 days. There is no need for you to take the adjustment factor now because bonus existing and rights, all of them put together have come. So 62, 53, 64, 182. So this comes to 27, 92, 72, 224. So your total weighted average number of shares is 5,996, 43, 471. So this is how you are going to determine the weighted average number of equity shares. Now let us come to the actual reported numbers. Okay, let us come to the reported numbers to see how the calculation looks like. Okay. Just okay. You can see the number of equity shares here. 62, 625,364. So is it matching my working? Yes. This is the number of shares after issue. So that is the number of shares that we have. Now, let us look at the EPS calculation. Very simple. Reported EPS for 2021 is going to be net profit attributable to equity shareholders divided by wins. So your basic EPS is going to be 5.72 negative. 5.72 negative. Is it matching my EPS numbers which are reported? Is it matching my EPS numbers? Answer is yes. Which page is that? Face of the page. You can look here. Basic EPS 5.72. All right, negative. This was a COVID year. EIH is into the hotels business. So they had a major loss because all hotels were shut down. So 5.72 is computed in this particular manner. And they had also done a restatement. Total profit for the previous period divided by the restated number of shares, divided by the restated number of shares. All right, so 57, 88, 88, 639. So that comes to 2.15. So you can check here 58, 2.15 is your reported number. It is 2.15. All right, is it okay? Yes. Any doubts? No doubts? Where from 18 lakhs and 22.5? Where are you seeing 18 lakhs? Where are you seeing 18 lakhs? Abrikesh, you want to unmute? Yes.
Sir, that highlighted in the green, first, second.
No, this you can, right now don't look at this. Okay.
Okay, okay.
This is not important.
Okay.
Okay. All right.
That's fine. Thank you, sir.
Okay, understood? All right, fine. So that takes care of the overall right scenarios. How are we going to do the calculation, even in the real scenarios? Okay, so that covers our discussion. So rights and bonus in totality, we have completed. Any doubts so far? Anybody? No doubts? Abrikesh, all clear? No doubts. Manish Kumar, any doubts? Sumit was there on the session. He's not there. Okay, fine. So that concludes our discussion on the rights factor. Okay, all right. So now what I will want you to do is you will have to try question 13 as homework. It is exactly the same as question 11, but you will have to do it without looking at the solution and try to solve it using both the methods. That means the rights adjustment factor as well as understanding the bonus component that we did for our understanding. Okay. So that will help you to cement the concept permanently. Okay. So you can look at that, and on similar lines, we have buyback. We have buyback. So like how we have theoretical X rights price, there also we will have a theoretical X buyback price. So I want you to try the buyback also on similar lines. It will be just the opposite of rights. Okay. So today you can try. If you still have any issue on the buyback, we can discuss this tomorrow. All right. So that takes care of bonus element in other issue, that is rights. Share split is similar to bonus. There is nothing. Reverse share split is consolidation. So that is also done. So we are okay in this regard. For reduction of shares without a corresponding change, what is the concept we take away from here? That you are going to record the existence right from the earliest reporting period. The weighted average number of ordinary shares outstanding during the period and for all periods presented. You shall adjust it for events other than conversion of potential ordinary shares that have changed the number of ordinary shares outstanding without a corresponding change in the resources. So that is 27. So we have done this. You can just go through this for the purpose of your understanding. Bonus shares, we did these questions. Yes. All right. I want you to try these illustrations for homework. They are on similar grounds. Okay. They are on similar grounds. You can try these illustrations for homework. Rights issue we have done. In the case of rights, what is the steps that you are having? We saw this X rights price adjustment factor. So this also you can try for homework. All right. We did question 12 in detail. This I have given you for homework. You can try. All right. This also you can do for homework. It's exactly the same. You are having issued capital 1.8 million. Profits for the year ended was 630 and 875. Company made a rights issue of at a 1:4 basis at 30. Market price before the rights was rupees 60. Calculate the EPS. So you can try it. Nothing new in this. Okay. All right. Same goes for this also. Okay. Shares before the rights issue, exercise price, date of rights, last date, market price, profits attributable to ordinary shareholders. So no issue. And this I have given you to try something on similar lines as rights issue. If we have any doubts, we can revert on this tomorrow. With this, we come to an end on the basic EPS part. We will discuss diluted EPS after a short break, or we continue. What would you prefer? Okay. All right. So, okay. So what we can do is we'll take a 10-minute break. It's 8:45. We take a 10-minute break and then we shall continue with diluted EPS and try to conclude this part today. Okay. All right. Fine. 10 minutes break, please. Okay. Come back. So let us continue with EPS. So we discussed everything that is related to the basic EPS part. Now we move on to the next one, that is diluted EPS. So what is the objective behind diluted EPS? Why do we have diluted EPS workings which are required, and how do we do that? So diluted EPS tries to provide a peep into the future. What could be the potential EPS that could come in the future on account of certain shares that have the potential to get converted into, on account of certain instruments that have the potential of getting converted to equity in the future. You could have convertible debentures, you could have certain warrants, you could have stock options. So in all these cases, today they are not equity shares, so they will not come in the basic EPS calculations. But in the future, they definitely have a potential of conversion. And therefore, at that point of time, your EPS is going to be recorded. And by virtue of that, what will be the implication on your EPS? So that is why you have this particular aspect. So when I talk about dilution, there is obviously an opposite, anti-dilution. So dilution means a reduction in EPS or an increase in loss per share. Anti-dilution means increase in EPS or a reduction in loss per share. So what is important for us to understand is it is only the diluted numbers which will be reported. In case there is any anti-dilution, we are not going to report that. Okay. So what happens? This results from the assumption that certain instruments are converted, warrants exercised, or ordinary shares are issued upon the satisfaction of specified conditions. This specifically is about contingently issuable shares, is what it is talking about. What do we understand by potential ordinary share? A financial instrument or other contract that may entitle its holder to ordinary shares, like convertible, preference, or debentures, options, warrants, contingently issued shares, etc. All right. So how do I compute the diluted EPS? The principle is the same. It will be the earnings divided by the number of equity shares, but the earnings have to be adjusted for any dilution impacts. So adjusted net profit divided by adjusted weighted average number of equity shares during the period. So you are going to do the computation. Basic EPS will be the starting, and to that you will do the adjustments of dilution to arrive at diluted EPS workings. Okay. So that is how we do. So basis that, let us run through some illustrations, some questions before we move on to the other matters. Okay. So that takes care of. All right. So currently we will not look at financial instruments because right now I want us to understand the diluted EPS concepts. Okay. So these questions, we just want to refresh whatever we have done, and then we will look at a separate problems where the application of financial instruments, in that regard, we will see what it is. So as of now, you may find certain inter provisions, intermediate ICAI provisions that we are going to see, but that is just for us to understand EPS. Don't take it otherwise. Okay, so that is crucial for us to understand, because if I mix up financial instruments and EPS, then it's possible that it becomes too much for us to cope up. So we first understand EPS, then I will marry it with the financial instrument concepts that we have studied in respect of convertible debentures, so on and so forth. We do have a couple of questions where we will be following those principles as well. And for the examination, that is what you will have to do. But today I run you through the understanding of diluted EPS. Okay. Now, let us start. Darbhanga Limited gives you the following information to compute the diluted EPS. Net profit for the year is given 2 crores. Number of equity shares outstanding is 40 lakhs. Basic EPS is 5. You just divide it, you get 5. Number of 11% convertible debentures of rupees 100 each, 50,000. So this is 11% convertible debentures. Each debenture convertible to 8 equity shares. Interest expense for the year is 5,50,000. So 11% each debenture convertible to 8 equity shares. Okay. And interest expense is so much. Tax savings related to the interest expenses 1,65,000. So the question is, how do we calculate the diluted EPS? So first one, you are given that the basic EPS profit is 2 crores. So we start off with 2 crores. Okay. Now, the number of shares is 40 lakhs. So 2 crore by 40 lakhs is rupees 5 per share. Then we do the adjustment for dilution. So 3,85,000 is your adjustment for dilution. How this is 3,85,000? 5,50,000 is the interest component that will be saved in the future when the debentures get converted to equity. So I will add 5,50,000, but by virtue of that, your tax on that also will go up. So 5,50,000 minus 1,65,000. So that comes to 3,85,000. So the numerator will increase by 3,85,000. The denominator, each debenture is convertible into 8 shares. So 50,000 into 8, 4 lakhs. So 44 lakhs. So 2 crore 3,85,000 divided by 44 lakhs. That gives you 4.63 diluted EPS. Always you have to do a check between basic and diluted. If the diluted working is lower than basic, that means you have to report this. In case this is higher, then it means there is no dilution. It is an anti-dilution, and you will report the basic EPS itself as the diluted EPS. Are we okay? Yes. So fairly simple. No doubts. Let us move on to the next one. All right. While calculating diluted EPS, effect is given to all dilutive potential shares that were outstanding during that period. So calculate diluted EPS from the following. Net profit for the year 85,50,000. Number of shares outstanding 20 lakhs. So the basic comes 85,50,000 divided by 20 lakhs straight. Number of 8% convertible debentures of 100 each. So that will be 1 lakh shares. Each debenture is convertible into 1 lakh debentures. So each debenture is convertible into 10 equity shares. Interest expense for the current year is 6 lakhs. Interest expense for the current year is 6 lakhs. So therefore, and tax related to the interest expense is 30%. So now you have to calculate the what you can say, you have to now calculate the basic and diluted EPS. Basic EPS we are done with. Basic EPS we are done. Now coming to the diluted EPS, well, I have my interest expense of 6 lakhs, which will be a saving in the future. But the saving will be only 70% of this. 30% will go into tax. So I will add 4,20,000. This will be 6 lakhs into 70%. So that is 4,20,000. So 85,50,000 plus 4,20,000. So that comes to okay. There is a calculation. Yes, it should be 89,70,000. Okay, yeah, there was a printing mistake. Coming next to the number of equity shares. Now here this was taken from the earlier questions under the ICAP. So clearly, if you have your your interest expense as 6 lakhs, it means your debentures have not been in issue for the entire period. So because otherwise it should have been 1 crore is 1 crore, right? Yes, into 8%. Your interest that should have hit the P&L should have been 8 lakhs. But in effect, it is only 6 lakhs. That means these debentures were in existence for 9 months only. And therefore, your number of shares potential will also be considered for 9 months. So 1 lakh into 10 into 9 by 12. So 7 lakh 50. So the diluted EPS comes to 3.26. You can see 89 by 27 comes to 3.26. So again, check the basic, check the diluted. Is the diluted lower than the basic? Answer is yes. So you can report the diluted number. You can report the diluted number. Any doubts so far? So 17 is done. Let us move on to the next. Let us move on to the next. Okay. Number of equity shares at the beginning, 50 lakhs. Net profit after tax for the year, 2 crores. Number of shares of rupees 10 each issued for cash. This is fresh issue, 10 lakhs. Issue of bonus shares on 1st October, 1:5 as at the beginning of the year, that is 10 lakh shares. Convertible debentures outstanding at beginning of the year, 10% debentures for 1 crore. Conversion ratio 1 share for 1 convertible debenture. Company tax rate is 40%. So now we have to calculate the basic and diluted EPS. Okay, fine. So first one, weighted average number of shares. I start with how many shares? 50 lakhs. These were there for entire 12 months. So 50 lakhs. Then I made a fresh issue of 10 lakh shares, which are there in existence for only 9 months. So that comes to 7,50,000. Then I come to bonus shares. So the number of bonus shares is how much? Issue of bonus shares as at the beginning of the year, 10 lakhs. Deemed to be there for the entire period. So this is 10 lakhs. So 67 lakh 50,000 is the weighted average number of equity shares that you will consider for the purpose of calculation. Is it okay? Yes. So now coming to the workings, profit for basic EPS is 2 crore. Vains is 67 lakh 50. So 2.96. Coming to the dilution. Well, you are having 1 crore. Rate of interest is 10%. So 1 crore into 10% gives you 10 lakhs into 60%. Tax rate is 40. So this comes to 6 lakhs only. So your earnings go up by 6 lakhs and your weighted average number of equity shares. Your weighted average number should be multiplied by. So 1 lakh into 10. So 10 lakhs, 77 lakh 50. So 2 crore 6 by 7750. Check the basic 2.96, diluted 2.66. So you can report the diluted number. Any doubts so far? Any doubts? No doubts. Okay. So yeah, that's what it is. So next. So this one you can try it out for homework. Question 19. You are having the same thing. Net profit for 2 years, number of equity shares, bonus issue, convertible debentures, and conversion ratio. So it's exactly the same. So please try question number 19. All right. Coming to question number 20. 20 has anything. All right. Net profit attributable to equity shareholders, number of equity shares. Average fair value, details of potential equity shares. All right, we have a new thing here, so let us do this first. From the following information of Bhadrachalam Limited, determine the order in which the dilutive potential equity share should be considered in the computation of diluted EPS. Determine the order in which you should consider for computation. So what happens is sometimes you may be having multiple instruments with dilution that could be possible. So what do I consider for the purposes of dilution is how you will is what will determine how your what you say how your diluted EPS will be counted. Suppose I have diluted instrument 1, 2, and 3. And I have my basic EPS. I have my basic EPS. So what I do is basic plus first dilution. What will be the number? Basic plus first plus second dilution. What will be the number? Basic plus all the three together. What will be the number? So you have to determine that instrument where dilution is maximum, and that will be your diluted EPS number. So obviously you should have a mechanism for doing that. So this question deals with how am I going to determine such a mechanism, and I will apply that for the purpose of our diluted EPS workings. So net profit attributable to equity shareholders 1.5 crores. Number of equity shares outstanding 25 lakhs. Average fair value of one equity share during the year rupees 100. Potential equity shares, I have options 1,20,000 with an exercise price of 75. Okay. Convertible preference shares 10 lakh shares entitled to a cumulative dividend of 8 per share. Conversion ratio 4 for every preference share held. 15% convertible debentures of 100 each, 12 lakhs. Each debenture entitled to 2 equity shares. Assume corporate income tax rate 30%, DDT is 10%. Okay, so this is for us to understand. So we are only required to determine the order which you will consider. So first one is, we have three categories: options, convertible preference shares, and convertible debentures. So when the option holders exercise the option, will I have any additional net profit? Answer is no. So this is 0. Additional number of equity shares, they will come and they will pay 75 rupees per share. They will pay 75 rupees per share when the market price is actually how much? When the market price is 100. When the market price is 100. So what is the bonus component in this? What is the bonus component in this? The bonus component is 30,000 shares. Why? Because for 1,20,000 they are willingly paying 75 rupees per share, but market price is 100. So the difference is 25, which becomes your additional shares for which no consideration will come through. So that is 30,000 equity shares. That is 30,000 equity shares. Are we okay with this? Yes. So earnings per incremental share is 0. Earnings per incremental share is 0. When option holders exercise their option and convert, the conversion in earnings per incremental share reduces. Okay, it is 0. Coming next to convertible preference shares. What do you save when preference shares convert to equity? Well, the dividend gets saved. The dividend gets saved. So that, and the dividend distribution tax also gets saved. So you are having 10 lakh shares into 8 plus 10%, 88 lakhs. And what are the number of shares you are going to get? 4 equity shares. So 10 lakh into 4, 40 lakh. So 88 by 40, that comes to 2.2. That comes to 2.2. Coming next to convertible debentures, you are having 12 lakh debentures of rupees 100 each into 15% into 100 minus 30% net of tax. So that comes to 1.26 crores. And each instrument, each debenture is convertible into two, what you say is convertible into two shares. So 1 lakh, 12 lakh into 2, 24 lakhs. So 1.26 crore by 24 lakhs, it comes to 5.25. So what is your priority for calculation of dilution impact? We start with the least, that is the least earnings per incremental share, and we move to the highest. So whenever you want to do the dilution, you first proceed with options, then you move on, in this case, to convertible preference shares, and finally you move on to convertible debentures. Are we okay with this? Yes, this is just an order. The application of this order we are going to look shortly. Okay, this is something that you have already studied earlier, so there is nothing new in this. Okay, all right. So question 20 is done. Okay. Now, let us understand the impact. Let us understand the impact. So we had a profit attributable to equity shareholders 1.5 crores. Yes, 1.5. Adjustment for options. So you move in that order only. So add adjustment for options. Nothing gets added in the case of profit attributable to shareholders. So it remains at 1.5, but number of shares gets added, 30,000. So 25 lakh 30,000. Coming next, adjustment for preference shares, 88 lakhs and 1.26 crores. So, sorry, not 1.26, 88 lakhs and 40 lakh shares. So 88 lakh, 40 lakhs. So 2.38 by 65.3, you still have a dilution that is happening. And finally, you have for debentures 1.26 divided by 24 lakhs. So 1.26 crore, 24 lakhs. So take the total, and at each stage, you calculate the diluted EPS. So first one, basic, that is 6. Dilutive is 5.93. And your, what you can say, your adjustment for debentures brings it to 3.64. But sorry, your adjustment for preferences brings it to 3.64. But when you have your debentures, 3.64 becomes 4.08. So debentures are anti-dilutive in this case, and therefore you are going to consider this as your dilutive number, 3.64. Are we okay with this? Are we okay with this? Yes. All right.
Aditya ji, your session is best. You know, I have been listening you with a great attention.
Yes, sir. Good
Your
morning,
session
sir.
is good morning. Good morning.
Yes, sir.
So keep it up.
Thank you, sir. Thank you, sir. Thank you for attending this session, sir. Yes.
Yes.
Any other feedback you can have, let me know, sir.
See, no. Perfectly all right.
Okay, sir. Okay.
Thank you. Thank
Thank
you.
you, sir. Thank you. Thank you. Okay. So coming to question number 21, I leave this for homework because it is on similar grounds. Yes, I just hope. Yeah. Fully paid, partly paid. So we are just combining all the concepts what we have studied so far. Fully paid, partly paid, outstanding options. We saw convertible preference shares, convertible debentures, income tax. Partly paid became fully paid on 1st October X1. Then you have bonus shares on 1st January X2. Net profit attributable. So you need to calculate basic EPS for the first 2 years, diluted EPS for the first 2 years, adjusted and diluted for the previous year. Assuming same information, also assume that partly paid shares are eligible for proportionate dividend only. So if you recollect, have we done all these concepts? Answer is yes. But we have done them in isolation. Matlab, we did partly paid shares. We have done dilution on account of debentures convertible. Yes. We have done dilution on account of preference shares convertible. Yes. We have done dilution on account of on account of options. Yes. We have done bonus. Yes. So in all these cases, we have done in isolation. This question just puts it together for you. So I want you to try this out for homework. Yes. Again, remember, not the ideal aspect of financial instruments as yet. So just do it so that you understand the adjustments of EPS. See, all these things are having an impact on the denominator as well as the numerator. Denominator, you are, if you get this correctly, see, basic is nothing but net profit attributable to equity shareholders divided by weighted average number of shares. And then plus you will have certain dilution impacts. So this gives you adjusted net profit attributable divided by adjusted weighted average. So though right now financial instruments, I'm just requesting you to ignore for the purpose of this question. Thereafter, it will only be a substitution of the amounts that you have already computed. There won't be any change on that front. Okay. So that is why get these concepts right. Then we can always replace it with our understanding of the financial instruments. Coming next. So try this. It's a very good question. It contains a lot of details for our understanding. Okay. All right. Fine. Next. So try this and try question 22 also. It covers a lot of things. So coming to our session. So this one you can do it for homework. I told you to try this 15, 16, 17. We did 18. I have asked you to do. Okay. All right. Now let us come to 10.63. Let's check. Fine. 10 lakh and okay. Okay, so this is something that we have done. So you can try this for homework. Go through the institute's question. Coming next, here also you can try. Sir, when do we do financial instruments? The key thing is, what is that one data that you require for financial instruments to be applicable? In all these questions, convertible debentures, convertible preference shares, what is that key data set that you require for financial instruments to be applicable? That is your effective interest rate. That is your effective interest rate. If effective interest rate is not given, even if you want to, you cannot do the applicability of financial instruments. So the effective interest rate, jab tak hoga nahi, you please go ahead and do the regular interest workings and presentations that we do. Okay. All right. So this I have asked you to do for homework. Just running you through the concepts. Okay. Determining the sequence for diluted EPS. This also we have discussed. I told you. EPS per incremental share is what we calculate. Whatever is the lowest, we give that number 1 and then we progress accordingly in ascending order. And for the purposes of calculating the diluted EPS, we will give on the incremental impact, we will go on adding to the basic EPS to arrive at the dilution impact. So this is stage A, stage B and stage C workings that you are going to consider. Okay, this I have left you for homework. Same for 21, I have left with you. Okay, all right. Determining the sequence for computing diluted EPS. Go through this in the case of options and warrants. I told you, consider only the free or bonus element. In that example you saw, we did 100 minus 75. 25 only was the bonus element, for which is the only number that you will have to consider. Because 75 ke liye to you are getting the money for that. Resources are coming in. And the numerator will obviously be zero. Options generally do not involve any payouts in the form of interest or dividend. Hence, adjustment to numerator would generally be zero. However, if options are measured at fair value through P&L, with the financial instrument हो गया, it would be adjusted in the numerator. It would be adjusted in the numerator. Are we okay with this? Yes, sure. Anybody has any doubts? So this one you can do it for homework. All right. Yes. All right. So go through these for homework. These are just examples. Yes. Padlo, you will be able to understand. Okay. All right. Fine. Options we have already done. Check this out. All right. Now we come to certain questions where you are having applicability of financial instruments. Okay. All right. Just a minute. After tax. Okay, fine. At 31st December 20X7 and X8, the issued capital consisted of 40 lakh ordinary shares of 25 each. The entity has granted options that give the holders the right to subscribe between 20Y6 and 20Y9 at rupees 70 per share. Options outstanding at 31st December X7 and X8 were 6,30,000. There were no grants, exercises, or lapses of options. The profit after tax attributable to ordinary equity shareholders amounted to 5 lakh and 6 lakh respectively. Average market price of the share is 120 year ended X7 and 160 year ended X8. Calculate the basic and diluted EPS. So this is not really very difficult. Yes, so you are having 6 lakh and 5 lakh as your what you can say, the numbers relating to your profits. Yes, the net profit, and you are having certain options. So number of options that you have is 6,30,000. Number of options that you have is 6,30,000. So number of shares at full market price, 6,30,000 into 70 divided by 120. The market price the previous year is 120. So 630 into 70 by 120, 3,67,500. That means the dilutive shares is 2,62,500 for the previous year. And for the current year at 160, your fair value is 2,75,000. So this comes to 354,375. So this is your balancing figure, the dilutive one. Okay. Now, when you talk about your number of equity shares, it works out as 40 lakh equity shares. So 40 lakh plus the dilutive plus the bonus component. So 4354, 4262, and your profit after tax is 6 lakhs and 5 lakhs. So just divide that and you get the diluted EPS. Basic was 15, this is 14. Basic is 13, this is 12. So there is a reduction in EPS. So this becomes a dilution that is there. Are we clear with this? Yes, are we clear with this? Any doubts on illustration 10? Any doubts? No doubts? All right. So that takes care of it. All right. Following information pertains to an entity. You have net profit, weighted average number of equity shares, average market price, weighted average exercise price under option. Calculate basic and diluted. Very simple. This had come in your November 21 RTP. Okay, so you can just do it. That gives you the solution. Okay. Illustrations, again, you have similar one. Yes, in your illustrations, try this out for homework. Okay, now we come to the next part, that is little bit application of financial instruments. Okay, so at 30th June 20x1, the issued capital of an entity consisted of 15 lakh ordinary shares of 1 each. On October 1, the entity issued 12,50,000 of 8% convertible loan stock for cash at par. Each 100 rupees nominal of the loan stock may be converted at any time during years X6 to X9 into a number of ordinary shares as set out below. 135, 130, 125, and 120 starting from these periods. If the loan stocks are not converted by 20x9, they would be redeemed at par. Okay. This illustration assumes that the written equity conversion option, this is the one, is accounted for as a derivative liability and marked to market through the profit and loss. Tell me, is it right to treat it as a derivative liability? Yes. Is it right to treat it as a derivative liability? What do you think? Yes. Obviously, it is right because your what you can say number of shares, because your number of shares are going on in accordance with a variable nature, right? See, if it is fixed for fixed test is what it passes, it becomes an equity. If there is a variable component on the conversion, it is a liability. At least that is what you would have studied in your financial instruments chapter. Correct me if I'm wrong, right? So when it passes the fixed for fixed test, it becomes equity. But here you can see with passage of time, there is a variability that is setting in. So you are treating it as a derivative liability and taking it to the P&L, which is right. A derivative should go as FVTPL. So that is what they are doing. The change in the options fair value reported in X2 and X3 amounted to losses of 2,500 and 2,650 respectively. It is assumed that there are no tax consequences arising from these losses. That means these losses are not tax deductible. That is, losses not tax deductible. The profit before interest, fair value movements, and taxation for the year ended X2 and X3 before interest, fair value, and tax amounted to 8,25,000 and 8,95,000 respectively, and relate entirely to continuing operations. The rate of tax for both the periods is 33%. Calculate basic and diluted EPS. Are we okay with this? Yes. Have you understood the question? Go through it once before we can do the solution. Okay. Done? Gone through? Shall we continue? Yes. So now, which enter 64 to 64. All right. Okay. So 20x3 and 20x2, starting point is net profit. What is your net profit? For x2, it is 8,25,000, and for x3, it is 8,95,000. Okay. Now, interest on the convertible loan, 12,50,000 into 8% convertible loan for how many months? 1st October x1. 1st October x1. That means 1st October x1. Okay, this is 30th June. So October to June means this is a period of 9 months for the first year. And second year, it was their entire. So interest is deducted. Change in fair value of embedded option, they have already given. The change in options fair value amounted to 2,500 for x2 and 2,650 for x3. So that comes to this figure. Change in fair value. So profit before tax 7,92,350. And tax at the rate of 33% on what? It will only be these two, because the last options are not tax deductible. The last one, the change in fair value, they have given it is not tax deductible. So therefore, 8,95,000 minus 1 lakh into 33%. So 2,62,350 is what is going to be your tax for the second year, and 2,47,500 is what is going to be your tax for the first year. So 5 lakh and 5,30,000 is your profit after tax. All right. And number of equity shares outstanding, well, that is the same, 15 lakhs and 15 lakhs. So 35 paise and 33 paise. 33 paise, 35 and 33 paise. Are we okay with this? Yes, are we okay with basic EPS? 9 months, na? Because see, it is issued on 1st October 20x1 and year is 30th June. So 1st October 20x1 to 30th June 20x2. First year, 9 months. It is 9 months for this. This is 9 months. Here it is 1 year. Did you get it, Abrakesh? Yes. Yeah. It is not March ending. It is June ending. Okay. Presumed nahi, Baba. It is understood. Because they have given data at 30th June. They have given during the years ended data at 30th June. So everything is given at the end of the reporting period. So वही लेना पड़ेगा. Yes. For the year ended 30th June 20x2 and x3. So that also is specified. So we have to do this. Okay. All right. Fine. Next one. So 35 paise, 33 paise is your basic EPS. Coming next to your diluted EPS. Now, what will happen in the case of diluted EPS? Sir, first of all, there are multiple conversion ratios. If conversion happens in the next year, 135. If it happens thereafter, 130. If it happens after in the third year, 125. If it happens in the fourth year, it becomes 120. So, kaun sa lena padega? What is the conversion ratio that you will have to take? So the standard is clear. When you report the diluted EPS, you have to report the maximum possible dilution. And maximum dilution is possible only when you undertake the maximum conversion that is possible. So maximum conversion is how much? 135 ordinary shares. So 135 ordinary shares means how many shares? 12 lakh 50 of loan stock. So that means 12,500. That means 12,500. So 12,500 into 135. This comes to how much? This comes to 16 lakh 87,500. This comes to 1687,500. Are we okay with this? Yes. Baki sab important nahi hai because it is at 135 ordinary shares that your dilution is going to be maximum. You are presenting the worst case scenario. You are presenting the worst case scenario. Are we okay with this? Yes. Any doubts? More the conversion, lower the dilution. So we want to report the lowest possible dilution. Okay. Now let us look at the workings. So your diluted EPS, in all diluted EPS calculation, your basic EPS is the starting point. Diluted EPS is equal to, this is the first year, 30th June 20x2, 5 lakhs divided by 15 lakh shares. 5 lakhs divided by 15 lakh shares plus. Okay. So now let us start. When I avail the conversion, the immediate saving that happens is on the interest. So interest will be saved. So how do I compute the interest saving? 12,50,000 into 8%. Yes. Into, they have already given the interest. Yes. 75,000. So this is what you are going to save. Plus 75,000 into 1 minus 0.33. Obviously net of tax. Plus, what are you going to save? The option loss will no longer be there because you are going to exercise option and convert. So wo option ab rahega nahi. So you will save on the option movements. And you are having share 1687,500 into 9 by 12. Why? Because the loans were issued on October 20x1. That means 9 months only. So when you work this out, it comes to how much? 0.20 per share. 0.20 per share. Diluted. It is diluted. Coming to 30th June 20x3. Diluted EPS is equal to rupees 5,30,000 plus 1 lakh was my interest for the next year into 1 minus 0.33 plus 2,650 is your second year's movement in the option value. So divided by 15 lakh shares plus 1687,500 into 12 by 12. So this comes to 0.19 per share. Compared to 35 or 33 paise, this is also diluted. So you will report this as your diluted shares. Are we okay with this? Yes? Any doubts? Abrikesh, did you follow? Manish Kumar Gupta, samajh mein aa gaya? Yes. How 5,30,000? Second year was 5,30,000, na? 8,95,000 minus 1 lakh minus 2,650. Taxation 262,350. So 5,30,000. Okay. Done? Any doubts? Clear, Abrakesh? Yes. All right. Fine. Manish Kumar Gupta. Okay. So that takes care of this illustration. Okay. All right. Okay. Next, we have a small concept. A minute. Okay. So there is another concept of written put options. ESOPs is the same as options what we saw, Abrakesh. It will not add anything in the numerator. And ESOPs, जो भी आपने दिए हैं, you have to assume that it will be exercised in totality and add it in the denominator. So that is the only impact. ESOPs are dilutive. Yes, ESOPs are dilutive. Okay. Any option is dilutive because it does not impact the numerator, but it adds the shares in the denominator. So in that sense, yes, ESOPs definitely are dilutive. Okay. Yeah. So coming to the next one, written put option. Written put option. What is this written put option? What is a put option? First, what is a put option? Option to sell. Option to sell. If I hold a put option, I have an option to sell. I have an option to sell. That means the opposite party is under an obligation to buy. Yes or no? The opposite party is under an obligation to buy if I sell. Yes. So in this case, the entity has a written put option. That means what? It is under an obligation to buy back its own shares if the opposite party has put it for sale. Are you able to follow? So a written put option is essentially an obligation to buy back. It is essentially an obligation to buy back. Okay, so we just look at that example. Assume that an entity has 160 written put options outstanding on 160 of its ordinary shares with an exercise price of 10 per option. The put obligation is therefore 1600. Average market price of the entity's ordinary shares is rupees 8 for the period. In calculating diluted EPS, entity assumes that it issues 200 ordinary shares at rupees 8 per share to raise the proceeds necessary to satisfy the put option. The difference between the 200 ordinary shares is so it assumes that it issues 200 ordinary shares at rupees 8 per share to raise the proceeds necessary to satisfy the put option. That means to buy back 160, it has to raise funds for 200 shares. So 200 aa gaye, but 160 will be bought back. So your bonus component is how much? Your bonus component is 40 shares, which will be added to the denominator in calculating the diluted EPS. No adjustment would be made to the numerator because this is assumed to be for nil proceeds. These are deemed to be for nil proceeds. Are we okay with this? Same like options, yeah, same like options. There is no change in the treatment. Okay. So it is same like options, no change. Okay. All right. Now, all right. Fine. So any doubts? No doubts. All clear. Okay. So I think students participating. Okay. This is what we will do tomorrow. Okay, fine. So we are almost through with this chapter. I think only the nitty-gritties pertaining to Ind AS, that is contingently issuable shares, number one. Second one, we are having your financial instruments, wherein we have one question left. And we are also having continuing and discontinued operations. These three concepts are there which are new in Ind AS. Apart from that, whatever we have discussed, majority of it is something that you already are aware of, something that you are already aware of, something that you know. So there we have completed those matters today. Tomorrow on the other front, I think we will require only about maximum 1.5 to 1 hour 45 minutes to run you through the other concepts, because I presume you would have gone through the sessions which were recorded. So I just run you through that and then we'll be through with Ind AS 33. Then the other side we have Ind AS 108 that deals with operating segments, yet another very small topic. Okay, for that I need just about half an hour to 40 minutes to wind up your Ind AS 108. Okay. All right. Three element options. Yes. I have explained this already to you. All right. Yes. Yes. Okay. That's it. So for today, any doubts? Anybody would like to say anything? Abrakesh?
Yes, sir.
Yes.
Yes, sir.
Tell me.
Sir, I'm audible?
Yeah, yeah, very much. Tell me. Go ahead.
Sir, my question is regarding very initial slide where you mentioned that there should be two classifications. One, equity share as a liability and another is equity. Very initial slide, sir.
Initial slide
Very
starting.
first, ekdam, very initial.
ये वाला
And where you have shown as a graph. I think it was handwritten.
ये वाला
Just a minute. No. Very initial, sir. Where you have mentioned that classification is required.
Okay. Okay, go ahead. What is your doubt? Go ahead.
So, I mean, at what stage this classification is to be made?
Acha. So that is the point which we are now going to look in tomorrow's session.
Okay.
The classification has to be done right at inception itself. The moment you have a financial instrument, we have to recognize it as a liability or equity, because that is the basis for determining where the figures will go. If it is a liability, though it could be a preference share, the effective interest rate will ensure that the interest gets captured in finance cost. Then the annual cumulative dividend is just a payout. It will not hit the P&L at all.
Okay.
Okay. So today what we have done is I have not even touched a financial instrument except the last question.
No, that is true. Just the stage of classification I want to know.
Initial, because otherwise how do we say that our books are in line with the Ind AS, right?
Okay.
So Ind AS 33 comes when all other things are put in line with Ind AS. Then it is just a matter of dividing the results by the number of shares. That's it.
Okay.
So
yes, thank you.
Uska two questions are there. We will do it tomorrow. They are fairly detailed questions, and I think you will be in a position to understand the concept better. Okay. Yeah.
Yes, sir. Thank you, sir.
Okay. Yes. Anything else? Nothing else? Okay. So with that, we conclude today's session.
Yes, sir.
We shall convene tomorrow again. All right. We'll meet tomorrow and close this chapter and Ind AS 108 also. Anybody has any doubts on the chat? Nobody is there in the POS live portal. Okay. So that concludes it. Thank you.
Thank you, sir.
Thank you. Yes.
Thank you, Ashok ji.
Thank you, Ashok. Thank you. Thank you.